How do you know how much debt a company has? How do you know what it owes to its suppliers? These are types of liabilities, and they can be found on the balance sheet. The balance sheet being one of the three main financial statements. In this lesson, you'll learn what liabilities are, why you should know about them, and the most common liabilities you can find on the balance sheet. In the previous video, I talked about assets. These are the things that the company owns that are expected to provide a financial benefit in the future. To pay for assets, the company has to use liabilities or equity. Liabilities are the things the company owes to lenders or other parties, such as suppliers or the government. The most obvious example of a liability is bank debt, but it also includes things such as accounts payable, accrued expenses, taxes payable, deferred tax, and provisions. Liabilities are listed on the balance sheet in the order that they are due. Liabilities due sooner will be listed earlier, and liabilities due later will be listed after. Liabilities that are due within the next 12 months are called current liabilities. Liabilities that are due after the next 12 months are called non-current liabilities. Current liabilities include things such as current portion of long-term debt, notes payable, accounts payable, accrued liabilities, and taxes payable. The current portion of long-term debt is the amount of long-term debt that is due within the next 12 months. Say you have a loan for $100,000 due within 10 years, but you pay back $10,000 each year. The loan is a long-term debt because it is not due within the next 12 months, but the $10,000 due this year is a current portion of long-term debt. Notes payable are sometimes called current debt or short-term debt. These are debts that are due within the next 12 months. Accounts payable is the money due for products that have been delivered but not paid for yet. For example, you own a shoe store. Nike delivers you a shipment of shoes today and gives you an invoice. The invoice says that payment is due within 30 days. The money you owe Nike is an accounts payable. Accounts payable is essentially a short-term, interest-free loan. Accounts payable can be good for you because you can get the shoes today, sell them tomorrow, and then use that money to pay back Nike later. Accrued liabilities, or accrued expenses, are expenses that have been incurred but not paid for yet. For example, your employees have worked for you this month, but you haven't paid them yet. Or you have used electricity, but the bill hasn't been paid. Taxes payable is the money the company has collected that will be due as tax this financial year. Add up all the current liabilities and we get the total current liabilities. Next, we have the non-current liabilities. These are the liabilities due after the next 12 months. Examples of non-current liabilities are long-term debt, deferred tax, and provisions. As I mentioned earlier, long-term debt are debts due after the next 12 months. Long-term debt can be a loan from the bank or money owed to bondholders. A bond is like a loan, but instead of getting money from the bank, you will sell bonds to the public. A bond is like a formal IOU. Deferred tax is caused by differences in accounting and taxable profits. Essentially, it is tax owed in the next financial year. This most commonly occurs due to differences in depreciation rules. Provisions is the money that is not expected to be recovered when products are sold on credit. For example, Nike provides a shipment of shoes to a retailer, but the retailer goes bust before they can repay Nike. Nike is aware this sort of thing can happen, so they set money aside called provisions. Add up all the non-current liabilities and you get total non-current liabilities. Add up the current and non-current liabilities and you get total liabilities. Now that we've defined the most common liabilities, let's take a look at Nike's balance sheet. Here we have the balance sheet for Nike as of 31 of May 2023. First are the current liabilities, including current portion of debt, notes payable, and accounts payable. Next we have current portion of operating lease liabilities. An operating lease gives you the right to use an asset but not ownership of that asset. For example, you might lease a store. Current portion of operating lease liabilities is the portion of the funds owed for the lease due within the next 12 months. Next are accrued liabilities and income taxes payable. Add them all up and we get our total current liabilities. Next, we have the non-current liabilities, but it is not clearly displayed where they end. This will usually be displayed for you, such as Apple has done here. Anyway, first we have long-term debt, operating lease liabilities, deferred income taxes, and other liabilities. Add these all up and you get the total non-current liabilities, which unfortunately Nike does not show. But here we have Apple's balance sheet where they do. We can quickly work out Nike's total liabilities by subtracting total shareholder equity from total assets. If you watched my video on the balance sheet, you will know that assets equal liabilities plus shareholder equity. So if we rearrange that formula, we can work out that liabilities equals assets minus shareholder equity. Nike has total assets of $37,531 and total shareholder equity of $14,004. That means total liabilities equals $23,527. As is usually the case, these numbers are in millions. You may have noticed another item on the balance sheet called commitments and contingencies. This is a third type of liability, but it is far less common. Commitments and contingencies are liabilities that may be due in the future due to things such as lawsuits. If we look at this item on Nike's balance sheet, it tells you to read Note 16. By reading Note 16, you can learn more about Nike's commitments and contingencies. The notes are a great place to get extra information on any of the items on the financial statements. Let's summarize. Liabilities are the things the company owes money for. Liabilities can be found on the balance sheet. The balance sheet lists liabilities in the order that they are due. Liabilities can be separated into current liabilities and non-current liabilities. Current liabilities are due within the next 12 months. Non-current liabilities are due after the next 12 months. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.